So today we're supposed to start a new topic, partnership. Sure. Yes. So right there, accounting for partnership. So I don't know in which topics you do these things. I don't know that it's in which subject. I don't know that it's in law or which unit where you cover partnership into details, where you talk of the advantages, the disadvantages of being in partnership, who are partners. So here in financial accounting, I'm not going to waste time to introduce who are partners and what are the advantages of running a partnership firm. No, mine is going to be which books of accounts and financial statements should a partnership firm maintain, and how are those books maintained? That is my concern. So the nitty-gritties of partnership, you can do them in those other units. So write down and say, partnership businesses, partnership businesses, partnership businesses. Get the answer. You can log out. Partnership businesses are required to prepare and maintain. No, before I go to that, sorry. Partnership businesses are controlled, stroke governed, controlled, stroke governed, controlled, stroke governed by the partnership agreement. By the partnership agreement. Full stop. Another hyphen. A written partnership agreement. A written partnership agreement is known as a partnership deed. Is known as a partnership deed. Full stop. Content of a partnership deed. 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 Number one. Content of a partnership deed. Number one. Capital contributions. Capital contributions by the partners. Capital contributions by the partners. Capital contributions by the partners. Number two, profit stroke loss. Profit stroke loss sharing ratio. Profit stroke loss sharing ratio by the partners. Profit stroke loss sharing ratio by the partners. Number three, the principal activity. The principal activity of the partnership business. Next, physical location and address. physical location and address of the partnership. And finally, rules governing admission, and retirement, governing admission and retirement of the partners. Full stop. Good. NB down there. NB. You say in the absence of a partnership, deed, comma, then the partnership business should be governed. By the Partnership Act. Act of capital A should be governed by the Partnership Act. Full stop. Another thing, the content of the Partnership Act. The content of the Partnership Act is similar. The Partnership Act is similar to that of a partnership deed. With the exemptions that a Partnership Act assumes equal capital contribution by the partners, and equal profit/loss sharing ratio. Between the partners. Full stop. That is it. Correct. Down there. In form of a subtopic, you say books of accounts. Stock financial statements. To be maintained. So partnership, there are books they are supposed to maintain. There are books which they do maintain. Number one, you say, so I can write them. One, the statement of profits, stock/loss account. They prepare the partners' current accounts. They prepare partners' capital accounts. accounts. They also prepare. So to avoid a lot, because this one almost comes together, the one we have written, statement of profits or loss account, you add in front here and appropriation. Appropriation account. Appropriation account, then the statement of financial position. Statement of financial position. All right, so we are familiar. We are familiar with this one. Sure. The profit account. So we are familiar with that. So I will talk much on this. I will talk much on this and this. This one is just a normal. So maybe in the profit account, what you need to know and appreciate is that in partnership, salaries. We normally have salaries. We have two salaries. There are salaries to the partners and salaries to the staff. So salaries to the staff is the one we expense in the profit account. But partner salaries, partners cannot be paid salaries until they finish paying all their expenses. So the partner salaries is not captured in the profit account. It's captured in the account known as appropriation what? Account. So let me explain this. So write that one as a subtopic. Appropriation account. Appropriation account, you say is an account which records in fact, your record not you just take me far. Instead of writing records, write it this way. It's an account which shows, instead of records, say shows, which shows how the net profit stock loss for the period, was distributed to the partners. Was distributed to the partners after taking into consideration the following. One, interest on drawings. Interest on drawings. Interest on drawings. Interest on capital. Partners' salaries, and commissions. Partner salaries and commissions. Full stop. So format. Down there you say format. So format is how it is prepared. So how do we prepare that account? So reported reported net profit, reported net profit stop loss, then you add, copy this format very fast, you add interest on capital, if any, not capital but interest on drawings. Interest on drawings. So if they took money and they're returning with interest, you add. Then you less interest on capital. Partner salaries, you also less. You less partners salaries. So what remains is the profit distributable to the partners. So what remains there, we distribute. So less profit share. Profit share. So I want to assume we have partner A and partner B. So they will share the whole of that profit in their P&L ratio. So that when you add this, you get this one here. Then this is nil. You must share everything. So have that. Have that, have that. So any moment you are required, good. 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 Let's go to the next, partners' current accounts. Let's go to partners' current accounts. Let's go to number 2, partners' current accounts. Janet, I requested you to subscribe. Did you subscribe? Remember, you were not in the last class. You're not there? Oh, what were iPhone? So, let's proceed. Partners' current accounts. Then you say there is an account which records the day-to-day, records the day-to-day transactions, the day-to-day transactions between a partner and the partnership firm. Full stop. It records all the appropriation accounts items. It records all the appropriation account items. Appropriation account items. Another hyphen. It is credited. It is credited. It is credited with all transactions that benefits a partner. All transactions that benefits a partner. And debited. And debited. And debited with the transactions which reduces, debited with the transactions which reduces partners' benefits, Full stop. Prepared as follows. So prepare as follows when they don't come with mail first. So right this way, partners current accounts,
And now,
so let's assume we have partner A and partner B. So if they tell you to prepare current accounts, this is what you do. Have that. Next, partners capital accounts. Partners capital accounts. Partners capital accounts. Partners capital accounts. Then you say partners capital accounts. Then you say is an account which shows the fixed account which shows the fixed capital contribution, the fixed capital contribution, and additional capital by the partners, and additional capital by the partners. By the partners. Full stop. Down there you say NB, unless otherwise stated, unless otherwise stated, unless otherwise stated, comma, goodwill and revaluation, goodwill, goodwill, goodwill and revaluation, goodwill and revaluation, goodwill and revaluation should be recorded in the partners' capital accounts. The partners' capital accounts. Full stop. So down there, I want us to draw partners' capital accounts. So if you are told to come up with partners' capital accounts, this is what you do. So balance brought down. Goodwill. Revaluation gain. But goodwill, goodwill is the reputation. If there is goodwill in the business, it must always be written off. So you write it off there. W stroke O stands for written off. Revaluation loss.
You're noticing something that over there. When I'm gonna know what, we must always disclose the data of the financial, historical, you want to see what kind of results of managers supply and Madam Chief, the best of my chief like they are only the government find out that
So that is it. Nothing much. Illustration. Illustration. So let's check illustration. So get out your past papers. Let me also pick mine. Illustration.
Because your interest and the growth are very fast. It's the responsibility to be supported. And then you really say, and you put there. So there's an error. Visual responsibility. 6 steps.
So partnership is divided into how many? 4. 1, just normal. 2, where a partner's been admitted to the partnership, where there is retirement of a partner, and where there is changes in policies, like profit ratio has changed. So I want to start with normal, then we check admission, retirement, and changes in policy. So that's what I'm trying to check. Let me just get a normal. Which has no stories about admission, retirement. The director does not. Why am I not getting a question which is quite normal? There are some there about admission, retirement, admission, retirement. So check this question. May 2016. May 2016. Question 2. In my paper, it is page 65. May 2016, question 2. Paper. So we read and it says, Maria and Bakari are in partnership, sharing profits and losses in the ratio of 2/5 for Maria and 2/5 for 3/5. 3/5 for Maria and 2/5 for Bakari. The partnership deed provides for interest on capital at the rate of 5% per annum. The partners are entitled to annual salaries of 1,700,000 for Maria and Bakari respectively. The following balances were extracted from the books of the partnership. So capital accounts, current accounts, inventory, building furniture, renovation of building, sales, purchases, rent and rates, electricity, bank balance, accounts payable, accounts receivable, repairs and maintenance, general expenses, insurance, carriage inwards, budgets written off, salaries, office expenses, provision for depreciation on furnishing, cash balance, drawings, Maria Bakari. Additional information. Inventory as at 30th April 2016 was valued at 15.6. Depreciation is to be provided on building at 2.5% per annum on cost. Furniture at 10% per annum on reducing balance. The following amounts were owing. Owing means outstanding. Salaries and wages 200, electricity 90. An allowance for doubtful debts amounting to 200,000 is to be made. Insurance paid in advance amounted to 40. During the year, the partners withdrew goods from stock for personal use as follows. Maria took 150, Bakari took stock worth 590. Required income statement. So income statement is the profit account, 12 marks. Statement of financial position, 8 marks. Let's start. Maria and Bakari. Maria and Bakari. Statement of profit stock loss for the year ended 30th April 2016.
In this case of the company's AOE specific amount of money can only be used
So shillings are in what? Thousands.
without the general
So we start with sales. Sales was how much? 87 or 60. Was there a return inwards? Nothing like that. Less cost of sales. Less cost of sales. So opening inventory. Opening inventory. So opening inventory. How much? Are you seeing 19? Add purchases. Add purchases. Purchases, are you seeing 62 and 40? Carriage inwards. I saw carriage inwards somewhere. Carriage inwards. Carriage inwards is the amount you incur to bring goods to the premises. How much is it? I saw it somewhere 960. Then you know the sum. The sum of this is called cost of goods available for sale. But there are some goods which the partners took. They took some goods in note number 6. Check the last note. During the year, the partners withdrew goods from stock for personal use. When you take goods, maybe you're selling clothes, then you decide to take some to put on. Will you say they are available for sale? No, so you less. So you less drawing of goods. Drawing of goods. When you take goods away, you remove. That is 150 plus 590. That is 740. You subtract. So can you give me the cost of goods available for sale? Cost of goods available for sale. So that one comes to how much? Huh? 82? 840. Then less closing inventory. Closing inventory. Note number 1, additional information, note 1, 15. Don't copy unless you have the same answer. Mtu mmoja anaweza kosea na wewe uendelee kucopy. 81 360. Copy at your own risk. 81 360. No, it's normal to mess up. The problem is now everybody is copying.
On the ground, the following was however,
so this minus this is the cost of sales, which is how much? 65? 760. So take this minus this, you get gross profit. Gross profit. Gross profit is how much? It comes so much. Extra says 21,700.
Yeah.
21,700. Is there any other income before I bring expenses? No. So less expenses. Less expenses. So expenses on top. There is renovation, but that renovation sometimes some people will capitalize it as part of cost of the asset. But now because we are not sure whether the asset is there, you expense. So renovation cost is how much? 15. Then after renovation, rent and rates. There was note number. Was there additional information affecting rent and rates? No. So pick it the way it is. 400. Electricity. 500. Note number 3. So 500, check note 3. Note 3, they said owing. Owing means not yet paid. How much? 90. You add. The accruals you add. 590. Then, apart from electricity, repairs and maintenance. Repairs and maintenance. 1320. I hope there was no note. Then general expenses. $47. Sure. Insurance. Yes, a note. 300. Note number 5. Prepaid. Prepaid of 40. So that is 200 and what? 60. Then we have bad debts written off. Bad debts written off to 70. Salaries and wages. Is a note,
Yeah.
Salaries and wages is 2,400. Subject to note number 3, owing. They have not paid. So that will be 26. Online, I'll be changing the camera. So next expense. So after salaries and wages, we have office expenses. How much? 600. Provision, no. Cash, no. Drawings, no. Note 1. Inventory, no. Note 2, depreciation. So depreciation. Buildings, they have said 2.5%. So 2.5% times, what was the cost of buildings? 85. So what is 2.5% of 85? So that will come so much? Yeah? 250. 212. 2 and 2.5, like that. Okay. Then furniture. Furniture, they say what percentage? Reducing, eh? Reducing means you take the cost, you subtract the accumulated depreciation. So what was the cost of furniture? 32. Then the depreciation which they had already charged in the peer and the trial balance, which you can see. How much is this? Provision for depreciation? 700. So take 32 minus 750, then you charge 10%. What do you get? What do you get? 245. Thank you. Note number 3, the following, done. Note number 4, an allowance for doubtful debts amounting to 200 is to be provided. Was there allowance for doubtful debts in the trial balance? No. So that is the increase. If it was not there, you assume 0. So 0 to 200. So that is the increase. So allowance for doubtful debts. For doubtful debts, they have said 200. Good. Number 5, insurance done. Number 6, during the year partners will do done. Which are that's all. So can you add for me all the expenses accurately? Add the expenses accurately. You have the answer already? 12, 897.5. Can one more person confirm so that we can report net profit? One person to confirm if that is true. Yeah. 2 people can't lie. So net profit, so take this minus that.
in the unrestricted expenses.
Number 3, whereby you are an insider.
So what was your net profit? Ezra is saying 8802.5. 8802.5. Then in partnership, now this is where now the tunapiga corner. Partnership, you don't leave profits in the books. For sole trader, profit account ends there. For company, now this is the time you go and pay tax, then you come and pay dividends. For partnership, you appropriate. Appropriating means unawagawia, but after checking for those small issues. So you say appropriation account. So partnership, you appropriate the profit. So you say, was there interest on capital? Yes, there was. So you say interest on capital. Interest on capital. It is where the question started. The partners did provide for interest on capital at what rate? 5% per annum. So interest on capital, Maria, Bakari. Bakari, 3/5. No, sorry. 10%. 10%. 10%. Where am I getting 10? 5% to Maria and Bakari. So check their capitals in the trial balance. What was the first item actually? Maria's capital was 12. This one was 5. So give me 5% of 12 and 5% of 5. Yes? 5%. Read where the question started, somewhere up, where the question started. You have seen it? Yes. So the first one is 600. Then 5% of 5. 250. So 850. Then partner salaries. So partner salaries, Maria was being paid how much? Maria was getting 1 million. This other one? So that is 17. So what remains is what we will share. So how much is remaining? Take that profit minus this, minus this. Subtract, then I will share to them now. So how much is remaining? 62? So what's the attached? 62, 52.5. Mimi kama nilikuwa sema Profit share. Profit share. Maria, how are they sharing profits? Equal, yeah? Oh, 3/5. 62, 52.5. 62, 52.5. Can you share those two profits?
Is the sale or purchase of property.
How much? How much? So 62, 52.5 times 0.6. 37.51.
Yeah.
62, 52.5 minus the answer. 25.01. It ends there. It ends there. That is how you prepare profit account for partnership. So if this was sole traders, naisha hapo. Kama ni limited, now this is where tax comes in and dividends. But for partnership, story ends there. Then next, they want us to prepare statement of financial what? Position. There is no way you can prepare balance sheet without you adjusting partners' current accounts. So before we go to the balance sheet, let's prepare partners' current accounts. So partners' current accounts.
Spouses of the employees.
Restart. So balance brought down. Current account immediately after capital. Top, second from top, 3,000. Then we have 1,000. Interest on capital. My space is why I'm shortening the wordings. Interest on capital, 600, 200 and what? 50. Partner salaries, 1,700. Profit share, 3751.5, 2501. Then drawings, there were two of them. There were two drawings. There was drawings of cash. Check the last in the trial balance. Are you seeing those drawings? There was drawings of cash and there was drawings of stock in note number 6. So you combine them to get total what this person has taken out. So add, take 28 for Maria plus the stock drawings of 150. So for Maria, you take 28 plus 150. How much is that? 29. Eh? Is that 29.50? Then for Bakari, cash drawings is 2,000. You take 2,000 plus 590. That is 25.90. Can you give me the balancing figures? This ones. Then we are done with that account. So balancing figures, you add this, subtract this here, that, subtract this there. Do that. Time is not on our side. Please be faster. Because I want us to finish that question.
So my next part is the law requires that insider trading be regulated. Which may affect the security.
What do you get? I know you have, but you don't want to give me. Huh? What 60? Kila mtu basi akae na anza yake. 600, 1,000, 37, 51.5 minus 29.50. 5401. 0.5. Then 1250 plus 700 plus 2501 minus 2590. Balancing figure is 1861. Mariam Bakari, statement of financial position. Statement of financial position as at 30th April 2016. I start non-current assets, so shillings are in thousands. So non-current assets. Alright, non-current assets, which one are you seeing? There was buildings, Buildings. Buildings. Tutamaliza kweli on time, 9 minutes. Buildings at cost was 85. And depreciation this year, there was no depreciation before on buildings. So this year you charge depreciation of 212.5. You have depreciated 212.5 on the buildings. So that one will be 85 minus 212.5, 8287.5. Then we have furniture. Furniture 32 minus, initially there was depreciation for furniture before 7 what? 50. This year furniture you have depreciated 245. Check your profit account. So 32 minus 750 minus 245. That is 22.05. There was no any other non-current asset. Add these two. So plus 8287.5. I'm getting 10,492.5. Can you confirm? It's okay, yeah? Current assets. Inventory. You take closing inventory. Check note number 1. 15,600. Receivables, look for it. Accounts receivable, I'm seeing 56. 5660 minus, there was allowance for doubtful debts of how much? 200. Yeah, it's okay. So that is 5460. As installed is payables. Then prepaid insurance. Insurance was paid in advance. How much? Note number 5. 40. Then cash balance, the second last. Cash balance, 2 what? 230. Nothing else. Add those figures. $21. So if you add the two, total assets 10,492.5. I'm getting 31. 822 point what? 5. Confirm. Confirm that. Are we good, ladies and gentlemen? So, then you say capital, so I want to delete this side. Capital and liabilities. I've also recorded the class, so you will be outside. So where you are not post. So no big issue. Janet, I requested. I will post them in my YouTube channel where I talk taxation issues. Wait, I know you're following the channel.
Yes, I am.
Yes. So you subscribe so that when I post, you just see the sound. Yes, 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 sure. So
So that's why I post the class.
yes. I channel them there. When you're saying something,
That's the Saturday class.
I'll be doing only Saturday. I cannot record all the classes. If I record all, Monday will never appear here again. So, capital and liabilities. So, capital and liabilities. Capital accounts. Capital accounts was not affected. Maria Bakari. So, Maria Bakari checked their capital. The first one, 12 and 5, 12 and 5, giving you 17. Then current accounts, Maria Bakari. Current accounts is the ones we have reconciled there. So take for online, you take these figures, this one's here, this one. So you will take 5401.5, 1861. Add the two. $72, 62.5. So if you can add this, that one comes to answer plus 17,024. We continue. Was there a loan? There was no loan. So current liabilities, payables, accounts payables was how much? Payables, where are you? 62. Yes. Then there is bank overdraft. I know bank overdraft might not be able to see it. They were pretending a lot. Are you seeing somewhere they have written bank balance? Are you seeing bank balance? In fact, it's in bold. Are you seeing the bank balance?
Yes.
But are you seeing it's on the credit side?
Yes.
That credit bank balance is an overdraft. Of how much? 1070. Then accruals. Accruals are expenses which we have not paid. Check note number 3. Check note number 3. 200 plus what? 90. That is 290. Add those 3. Add the 3. Then you tell me the answer for the 3. When you add the 3, what do you get? 75, 60. So total capital and liabilities. Total capital and liabilities. Total capital and liabilities. 24 plus 75. When you add, will it balance with your total assets? To balance it, then we are accurate. 31,822.5. So somebody will be asking me later, or when you will be revising, you will be asking yourself, why in limited retained profit was being captured here, in sole traders net profit was being added to capital, but in partnership net profit is not here. We are not seeing them here. Even what's not happening? The net profits, they are being captured in the current what? Accounts. When you check the current accounts balances, how you arrive at these balances is after adjusting for, you understand? So the profits and all that have been taken care of in the current accounts. So Ezra, thank you. Yeah, balance Ezra is okay. So that is it. When we meet in the next class, write for me a subtopic: changes in partnerships, changes in partnership businesses, changes in partnership businesses, changes in partnership businesses. So changes, we'll check where there is admission of a new partner, then there is old partner who is retiring, and then maybe they want to change the profit policy. How do you go about that? So that is for our next class. So thank you. Unless someone has a question, I beg to stop at that point. Who has a question? No question. So the video will compress. I'll send it before 8 p.m. for your own revision. Remember to subscribe to the channel. So thank you. You have a nice weekend.